from material terms to financial execution. As we move forward from Section 28, where we focused on the material terms and conditions of a property management agreement, we now step into one of the most important practical parts of that agreement: monetary handling and reporting. If Section 28 explained what the agreement must say about duties, responsibilities, compensation, and duration, Section 29 explains how the money is actually handled once that relationship is in motion. This is where the agreement moves from promises on paper to real-world financial performance, accountability, and transparency. One of the first and most important financial issues in property management is the handling of tenant deposits. Security deposits are not casual funds that can simply be mixed in with operating money. They must be handled carefully and according to Arizona law and the terms of the agreement. The property management agreement should clearly explain where deposits will be held, whether the account is interest-bearing, the lawful uses of the deposit, and the process for returning any unused portion. This ties directly back to earlier sections on trust accounts, trust account liability, and security deposit management. A strong agreement makes it clear from the beginning that these funds are being held for a specific purpose and must be protected accordingly. Another important monetary component is the operating reserve. The agreement should state the amount of reserve funds the property management firm will maintain for emergencies and how those reserves may be used. This is especially important in property management because problems rarely wait for convenient timing. A plumbing leak, HVAC failure, or electrical issue often requires immediate action. By setting a defined reserve, the agreement gives the property manager a practical tool to protect the asset without constant delay. At the same time, the agreement should explain how that reserve will be replenished if used, ensuring that emergency funds remain available when needed. This connects directly back to prior discussions on maintenance, supervision, and owner obligations. The handling of rent payments and other owner funds must also be clearly spelled out in the agreement. The contract should explain how rent is collected, how it is deposited, how and when it is dispersed to the property owner, and what happens with late fees or other penalties. This is a crucial part of both compliance and communication. Owners want to know when money will be available, and brokers must have clear systems to avoid confusion or disputes. This ties directly back to Sections 21 and 23, where we discussed financial control, balance sheets, trust account liability, and the broker's responsibility for all funds handled by the firm. Financial reporting is equally important. A strong property management agreement should state how often the owner will receive financial reports, what those reports will contain, and how they will be delivered. Monthly statements, annual summaries, and detailed income and expense reports help owners understand how their property is performing and give them the information they need to make informed decisions. This ties directly back to Sections 18 and 20, where we discussed communication, responsiveness, business goals, and transparency. Good reporting is not just accounting, it is part of building trust in the management relationship. The management of trust accounts is also part of these reporting provisions. The agreement should explain that rents, deposits, and other owner funds will be held in separate trust accounts and not commingled with brokerage operating funds. It should also address how interest is allocated if the account earns interest and whether the owner has any right to request or review account records. This directly connects to Sections 22, 23, and 26, where we examine signature cards, broker liability, and ARS, paragraph 32-2174C. In those sections, we established who may access the funds and who remains liable for them. Here in Section 29, we show how the agreement itself should explain that financial system to the owner. The agreement should also confirm compliance with legal and regulatory requirements regarding money handling. This includes state laws governing tenant deposits, trust accounts, record keeping, and financial disclosures. Without this compliance language, the contract may fail to fully protect either party. This ties directly back to earlier sections on ADRI oversight, Arizona statutes, and the requirement for brokers to maintain consistent and accurate financial records. Monetary handling is not simply a business process, it is a regulated activity. Another major component is status reporting. Property owners should not be left guessing about the financial or operational health of their property. The agreement should specify the types of reports to be provided, such as financial status reports, tenant reports, maintenance reports, and occupancy reports, as well as the frequency of those reports. Monthly financial reporting may be appropriate for active properties, while quarterly maintenance and vacancy reporting may also be useful depending on the portfolio. This ties directly back to earlier sections on communication and responsiveness. A good property manager is not only collecting and dispersing funds, they are also keeping the owner informed in a clear and consistent way. The agreement may also provide for special reporting requests, such as custom financial analysis, cash flow summaries, or specific maintenance updates. While these may not be needed in every relationship, their inclusion gives flexibility and can help accommodate owners with more detailed oversight preferences. This is especially helpful when working with investors or multi-property owners who want more than a standard monthly statement. Finally, the ownership transfer clause is an important part of this reporting and accountability framework. A property owner has the right to know who is managing their property and to approve any transfer of that relationship to another licensee or entity. The agreement should clearly state that no assignment or transfer can occur without the owner's written consent. This ties directly back to Section 27, where we discuss the enforceability of the property management agreement, and to Section 28, where we emphasize that the material terms are what make the agreement functional in real life. A transfer clause protects the owner from being unexpectedly placed into a new management relationship without approval. As we tie this section back to the prior ones, the sequence becomes very clear. Section 27 established the property management agreement as the governing contract. Section 28 focused on the material terms that define the relationship. Section 29 now takes those material terms and applies them to the money, how it is collected, protected, reported, and explained. In property management, trust is built not only through words and services, but through how money is handled and how clearly that handling is reported. Online discussion. Why are monetary handling provisions so important in a property management agreement? Answer: because they explain how deposits, rent, reserves, and trust funds will be handled, creating transparency and reducing the risk of disputes or misuse of funds. How does regular financial reporting strengthen the relationship between the owner and the property manager? Answer: it keeps the owner informed, builds trust, and allows the owner to make informed decisions about the property's financial performance. Why should an agreement clearly address operating reserves and trust accounts? Answer: because both involve client funds, and the agreement must explain how those funds will be protected, used, and replenished in compliance with Arizona law. Multiple choice questions. What is the main purpose of a trust account in property management? To hold client funds separately from brokerage operating funds. Answer: to hold client funds separately from brokerage operating funds. Why is an operating reserve included in a property management agreement? To provide funds for emergencies and unexpected expenses. Answer: to provide funds for emergencies and unexpected expenses. What is the purpose of regular financial reporting to the owner? To provide transparency and update the owner on the property's financial status. Answer: to provide transparency and update the owner on the property's financial status.